This is covering sales discounts, the gross and net methods. It should have been covered in your intro course, but this is for review purposes for intermediate. The problem is basically how to record things with the gross and the net method. On March 14th, that's going to be the date we're going to use for our example, a company called Birch Company sold to Geronimo merchandise that had a sales price of $5,000 with terms of 110 net 30. The 110 net 30 means you have a 1% discount if you pay within 10 days. If you don't pay within 10 days, whatever's not paid is the net amount, I should say not paid or returned, and that has to be paid within 30 days. You're required to come up with some journal entries for the basic March 14th purchase and a journal entry assuming that the cash was received on March 24th and assuming that cash was received on March 25th. So one of the things you want to stop and think about is why were these dates selected? Well, if you have 10 days to pay and you started out on March 14th, 10 days later is March 24th, so you're going to get the discount period. If you paid on March 25th, that's 11 days, you don't get the discount period. So let's proceed with the journal entries. In doing so, one of the first things you want to think about is how much you would have for the discount. Well, if it's 1% times your $5,000 in purchases gives a $50 discount. And that's just the number we're going to show when we do the gross method and the net method. The gross method simply means you're going to make your journal entry at the total amount without taking anything into consideration. So what you end up having is accounts receivable, I abbreviate that as A/R, and your sales revenue, nothing new here, for the amount of $5,000. And again, that's nothing new, that's what you covered in your basic financial accounting course. The net method you may also have covered, but the net method is when companies assume you're going to take the discount. And I can show you lots of reasons that say basically it's cheaper to take the discount. It's actually cheaper to go to a bank and borrow money to get that discount. But we know the discount's $50. We know the purchase is $5,000. So a $50 discount means the company's really only expecting to collect $4,950. So they make their journal entry for $4,950. Notice both journal entries debit accounts receivable and credit sales. The only difference is the amount. The gross method takes everything at $5,000 and the net method assumes the discount will be taken. On March 24th, under the gross method, the cash is received at $4,950. So we've got to go ahead and record that with a debit to cash for $4,950. We're going to show the sales discount. This sales discount is a contra asset account, which means it has the opposite balance. So instead of having a debit balance, it has a credit balance. And it offsets the related account. So what you end up with is sales of $5,000 minus your sales discount of $50, and your net is $4,950. So the journal entry debits the cash for $4,950, debits this contra asset for the discount amount of $50, and credits accounts receivable for $5,000. Also note that the accounts receivable have to match. So the amount in the original entry of $5,000 has to match the credit when the accounts receivable is paid off. So even though the company only paid $4,950, they don't owe anything. So we have to eliminate the accounts receivable at its total balance. So when you're finished, the accounts receivable for that customer has a balance of 0. Under the net method, you've got similar things. The net method assumed the discount would be taken. So the net method already took into account the discount of $50, and they just debit cash and credit accounts receivable for $50. They also make sure that the credit to accounts receivable matches the debit and is at the $49.50. Now notice for both of these methods, the net sales is $49.50. The one method starts out assuming the discount's taken and gives you the smaller amount, and the other has to take into consideration the contra asset account. But both end up at $49.50. That's your net realizable value. It's the amount of cash that was realizable from the sale. It's the amount that's reported on the income statement, and it's the amount allowed by the IFRS and by GAAP. Now, if on March 25th the cash is received on that date, there ends up being no discount because it's 11 days. So the discount period was missed. Under the gross method, which assumed discount periods were going to be missed, there's nothing really to talk about. This is an entry you've been dealing with forever. The debit is to cash and the credit's to accounts receivable for $5,000. And note, the amount of the receivable debited in the original entry matches the accounts receivable credited in the ending entry. On the net side, though, the discount was expected to be taken. So you're going to have the same kind of issue. Originally, it was debited for accounts receivable for $49.50. So we need to credit accounts receivable for $49.50. Because when all is said and done, that customer doesn't owe any more or any less. Their balance is 0. But they end up paying $5,000. So you end up with a need for a credit for another $50. Well, that account's called sales discount forfeited. It's an additional revenue account. Under the gross method, you end up with net sales of just the original sales of $5,000. And that is exactly what the sales and the estimated collectibles are, the realizable collectibles. Under the net method, you started out with an expectation of having $49.50 collected, but an additional revenue of $50 was received. So you end up with a net realizable value in the sales of $5,000. So both cases, the net method and the gross method, allow for the discounts to be taken and not be taken and still follow the IFRS and GAAP.